Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be taking a look here at the M1 Finance Roth IRA buys for May 6, 2019. We're going to go over what stocks I'm looking to buy here on Monday. We're going to be looking at why I'm going to be buying these three specific stocks. We'll take a look at their earnings, their past earnings or their current earnings that have came up. I know a couple of these have actually gone through earnings, the quick fundamentals of the company, and then sort of my little process of why I'm buying these ones. So if you are brand new to the channel, hit that subscribe button below. If you do enjoy the video, find it helpful, hit that thumbs up. And if you have any comments, questions at all during the video, drop them in the comment section. If you have suggestions for upcoming sort of topics, drop them in the comment section below, and let's go ahead and get started. So my method of investing is slightly different than everyone else's. Everyone has a different way of investing. While we all may follow some of the same fundamentals, our whole process of why we're picking specific stocks and why we end up buying them is a little bit different. Now, when I look at my overall portfolio, some may say, okay, I have 31 stocks in here. That is a lot of single stocks. Why do you hold so many stocks? Well, I like to hold at least 15 is my minimum normally in most portfolios, because this way it gives me a diversification. I can put at least 5 or 6% into 15 different stocks and be pretty well diversified there. Now, I have continued to grow this portfolio from an initial portfolio of about 15 to now 31. This gives me a really good range because I will have positions here such as Cisco, ABM, General Mills that I initially started to invest into. These were ones that I bought here back in just November, December time period that are not giving me that value that I was looking at initially why I bought into these stocks. Now in the future, they may have some bad earnings, they may have some bad news that causes them to drop by 10, 20, 30% at a time and come back to what I believe would be fair value or a value position to begin averaging back into them. But at the current time, these are not ones I do not want to increase my unit costs. I don't want to be decreasing my yield on costs. While I will get some dividends by buying into these stocks up here, I won't get the best bang for my dollar. So Cisco, let's say for example, I bought Cisco for $1 and it paid out a quarter per every quarter it paid out a quarter. So over the course of a year, you get $1. You buy it for $1, you get $1 at the very end of the year. Well, now it's up 50%. So now you're buying it for $1.50, but you're only getting that dollar payout. The other way around, if you bought it for $1, it dropped by 50%, and you bought 2 shares for $1 at 50 cents, they both pay out $1. Now you're making $2 in dividends. So the way that I look at it is I want the best bang for my buck while I'm investing, and I am trying to look for value out there in the market. I'm going to be making a video probably on Wednesday. I'm going to be going through some of the big dividend aristocrats that have grown and paid out dividends for 25 plus years. We'll go over, take a look at their fundamentals very quickly, skimming out and knocking out anything that's not really worth investing for me, kind of making a list of what stocks I want to be maybe possibly added into the portfolio that have been getting dragged through the dirt here in 2019. But kind of jumping back over here. Now, the opposite end of the spectrum, I have 31 stocks. Of those 31 stocks, we have 2, 4, 6, 8 stocks that are negative out of 31. Now, these stocks here, which of these stocks are currently down on the week just because of some weird news? So if I do this again and look at it for the 1 week, okay, we can see Kellogg's is down 4.93. We'll say 5% for the week. It's down in a single week, 5%. Triple M, it was down last week, I believe around 11, 13%. Now this week down an additional 3.35%. We have Cisco losing a little bit of steam now that it's up nearly 50%, AbbVie, and Lowe's. Now, I have a spreadsheet here that I use. I have one for free. It's not as detailed and filled out as mine, but it's somewhere along the case. I'm going to be working on filling up that spreadsheet. It's available on my website currently for free, but I'm going to be creating this and making a video and then creating a price for it. So you'll be able to get the spreadsheet. You'll be able to have a video on how to fill it out for yourself, but it won't be for everyone out there, but we shall see. But anyways, the way that I look at this is these stocks right here are the same ones that are down overall here for the portfolio, just the 8 stocks here. But I look at it here, I look at M1 Finance here on a week basis, And then, okay, Kellogg's Triple M, I'm down 3%. I take a look over here, Kellogg's, I'm down 5%. Okay, Kellogg's just went down 5% this week, and now overall, it's down 5% in my portfolio overall. So this week alone, it caused Kellogg's to go from a green to a red. Now I'm getting an opportunity right now to buy into the stock that I haven't had the opportunity for a while. If I look at the performance of Kellogg's here over the past quarter, Kellogg's has been in a pretty good uptrend, just continuously uptrending since my initial buy point. It's gone nowhere else but up. Well, now I'm getting a little bit of a sell-off here, 5% sell-off, putting it down into the negative now for my initial buy price. So now I can go in here and say, okay, Kellogg's, I had $374 of equity. I want to continue bumping this up to that $600–700 range for equity. So Kellogg's is on my list of buys, plus this one is going ex-dividend here sometime in May. Now I take a look at the others here as well. Triple M was in here. Triple M is right there, 6.16 down in the portfolio. This is from the past 2 weeks. We also have, what was the other one here? Walgreens here. Walgreens has been getting slammed the last few weeks, but because I've been dollar cost averaging, if you've watched my past few weekly videos, I have been continuously adding $100 here, $100 there, $100 here to Walgreens. And you can see here that overall, I'm only down 1.33%. I'm buying Walgreens at a current dividend yield of 3.25%. My own dividend yield's 3.21. This stock, because I've been buying, I only own $340 of it, but going forward, they're going to be paying me out nearly $11 every year going forward, and eventually, Walgreens is going to be up in their dividend. They're on the 4th quarter of paying out that $2. That's Medtronic, but those other ones aren't arranged the correct way. So yeah, we'll go back at there another day. But Walgreens, I believe that they are going to be actually, I guess I kind of want to take a look at it now and look at Walgreens. So Walgreens is down here. They're on their 4th quarter of paying out $1.76 per year, or 44 cents per share each quarter. So sometime they're going to be announcing a dividend raise, because that's what they do. They've grown and paid out dividends for the past 44 plus years, 43 going on 44, I believe. And they're going to continue to do it. So eventually, while I still own these same shares, I'm going to go from $11 to say maybe $12 or in some change, somewhere within that range, just by holding these specific shares. Now, I believe I'm kind of rambling on now. So, one, I've looked at in the week, have I had any discounts that have given me the opportunity to have stocks now in the negative? Kellogg's and Triple M recently have put a few positions that I haven't been able to invest in and average into for quite a while into the red. Triple M has been on fire lately. It's now giving me a 6.16% discount from when I initially decided I wanted to invest in this company. And Kellogg's is giving me a 4.87% discount from when I initially made the the investment in the specific stock. Now, it's May currently, so I have Triple M here that is going ex-dividend in May. I have Kellogg's that's going ex-dividend in May, and I have Walgreens, which is going ex-dividend in May. Those are my 3 stocks here that are going ex-dividend in May. Now, here's the first, Triple M. Grown and paid out dividends for the past 60 plus years, low payout ratio of 56.1. They pay out $5.76 per year each share, and they are offering a yield of 3.11. Now, up towards the top, they normally have upcoming payouts here of dividends. They don't have it, but an easy way to check it out, scroll down here to their dividend history, and because they haven't announced it yet, you'll just look at that last one. So normally, they go ex-dividend all around May 17th. Here we can see another May 17th. And currently, it is, May 17th is next Friday. So I have about this week and next week to buy a little bit of Triple M before they go ex-dividend. And as long as Triple M stays into that negative, I'll probably continue to buy into Triple M. That's actually a stock here that I recently reinvested my dividends back into. I bought up some Triple M. So that is one that's on my buy list. Also, Kellogg's, growing and paying out dividends for the past 14 years since 2005. What happened in 2005? Well, they froze their dividend. We went through the recession, so between 1999 all the way until 2005, they locked out their dividend at 25 cents. locking out a dividend, it's not dividend growth investing where that dividend is growing, but they didn't cut it. They didn't stop paying a dividend. So in my eyes, the reason that they did freeze it out for so long is, yes, we had that recession, but back here they did a 2-for-1 split and they continue to grow and pay out that dividend. So if you were getting paid out $100, if you had 100 shares and you were making, what's their payout? $100, 100 shares, and they were paying out $224. You're making $224. I don't know if that's correct. Let's just say that you were making $224, and they doubled your shares. Now you're making $448 of dividends per year just based off your shares doubling, because they didn't cut their dividends. So that's the way there. They have a good payout ratio under that 50-60% there at 49.6. Current yield around 3.97, and they go ex-dividend here on May 31st. So they'll be going ex-dividend on May 31st here towards the end of the month. So I got a few weeks here to invest, plus I'll be buying. They will probably announce a dividend increase if they haven't. So here, this is showing 56 cents per share payout. The other website here for, what was that, Walgreens, so it was down here. The other one that I used to kind of keep up with dividend income, that was obviously not it. It's NASDAQ.com. So if you go to NASDAQ.com, punch in the ticker symbol here, and then on the left-hand side, you will see dividend history. Now this one is generally a little bit faster to update their information. So Walgreens, they have it. Oh, this is their last quarter that they're going to be paying out that 44 cents per share. So here they did announce their ex-dividend on May 17th, 2019. Oh, we've already looked at Walgreens. What was the other one we were looking at? Was it Kellogg's? Okay, it may have been Kellogg's. Okay, so let me go back to my here and type in K. Do the exact same thing, and we'll go to history. So here they have 56 cents of growing and paying out dividends. The next quarter coming up, afterwards, they'll probably announce a dividend increase, maybe just something slight of 2 cents per share, but it just continued there. And let's see here. The last one was Walgreens. Okay, so we have Triple M, Kellogg's, and Walgreens. I'm not sure if I'm getting lost a little bit there, but all of these are on their fourth quarter of growing and paying out dividends here. They have 4 quarters of growing and paying out those dividends. Walgreens, 44 cents per share. Kellogg's, 56 cents per share, and Triple M, 136 cents per share. They actually just bumped up their dividend here. So on their upcoming dividend on May 17th, they're going to be paying out this new payout of $1.44 per share in this next upcoming dividend payout. So those are my 3 stocks I'm going to be buying. There are earnings whispers, so this is another website. You take a really quick look over at this website if you're interested in checking out companies' earnings. Earningswhisper.com is a great one for this. So here, Triple M announced it. They missed. You can see here overall how they performed. So they missed by 11.5%. Here we have the reported earnings of $2.23, whereas they had a estimate of actually $2.50. So that was a miss there of 11.5%. Here, their revenue. Their expected revenue was $8.09 billion. They missed it here at 7.86. It was a miss of 2.8%. So you can see revenue growth down to 5%. That is why Triple M fell. If we take another look here at Kellogg's, okay, Kellogg's recently, what was it? They went down 5% this week. So we do the exact same thing with Kellogg's. Okay, why did they go down? So they actually beat. They beat their earnings. They came out reported at $1.01 when they were estimated at 95 cents. That was an increase there of 44.1%. Revenue beat by 0.1. They expected 352. They came in. They probably came in a little over 3.52 billion, but they were expected at 3.52 billion. And we can see revenue growth up 3.6%. Earnings growth down over the year 15.1. So here they probably lowered their guidance. So they say the company had expected blah blah blah. Company's previous guidance was earnings December consensus estimates. are involved. Okay, so the company said it expected 2019 earnings of 385 to 390 per share after its departures and company previous. Okay, so they lowered their guidance. So the reason that Kellogg's fell by 5% is that they beat on their results, but they lowered their guidance here from $4.02 to $4.10 to now $3.85 to $3.90. That is the reason that they fell by 5%, because they lowered their forward guidance. And the very last one was Walgreens. So we take a quick look at Walgreens as well, and we take a look at the earnings here as well. So here we can see Walgreens right off the bat, they did miss. Now that is why they probably have fallen here recently. So they missed their earnings by 4.6. They missed their revenue by 1%. They have some revenue there, growth, 4.6%. So here, the company said it expected 2019 approximately $6.02 per share. The company previous guidance was $6.44 to $6.74 per share, and the current consensus earnings estimate was 7. Okay, so this isn't actually that bad. This Walgreens probably fell just because they missed their current earnings, but they've actually, it looks like they did lower it. Okay, so they're expecting $6.02 per share when they had initially had their guidance at $6.44 to $6.74. So they cut back their guidance by quite a bit there for the year. So that's why they fell. So they missed, plus they lowered their guidance. They lowered their expectations. So that's why Walgreens has been taking that bit of hit here recently as well. So those are the three stocks and why they were recently given that sort of hit to them in the recent times. And they're all solid companies. They're not going to just go out of business here in the next few years. I'll still be able to buy into these specific stocks, and they'll still continue to grow and pay out a dividend into the future. There's no risk as far as there's no risk to their dividend. There's no risk to their future growth. So if we take a look here at the, price and yield. We'll look at the price and yield for the 1 year. Take a look at them individually. Here, what you're getting an offer here for the year, you're getting it Triple M at its highest yield besides back in December 2019. So you're just getting that yield again of around 2.98%. Kellogg's here, if we're looking at it for the year, if you're buying into Kellogg's at this current point for the past year, this is one of the best opportunities for capturing that dividend here of 3.93%. As we look back here over the past 5 years, Kellogg's has not been at a dividend yield of 3.93%. Even going back into 13 or so, the dividend yield has never been really up that high. Walgreens here, 3.18. Currently, these are the same dividend yields as back in 2013, in that range here when the markets were really hit pretty between 2013 2015. We can see here a little bit of a downturn in the markets, but we're getting that yield now of 3.18. And again, these are all stocks that have dividend yields, dividend payouts less than 60%. Also, when we're looking at their free cash, here they have a free cash flow of 5.68 billion. Triple M, if they were, they're paying out their shareholders 4.63 billions in payouts. So what sort of a payout? If we were just looking at their free cash flow, that's 6.34 divided by 5.68. So while we're not looking at their earnings now, we're looking at their free cash flow. If for whatever reason they needed to use their free cash flow, Triple M still has a payout of their free cash flow of 81%. So while their earnings do cover it, if they were to have some really hard times, they could still fall back on their free cash flow and use that as well. Again, we go over, let me move that back out, and we took a look here at Kellogg's now. Kellogg's has $540 million of payout, and divide that by their free cash flow of $484 million. That gives them a free cash flow payout of 68%. We have Walgreens here of $5.816 billion. So this is the only one of the three which has more common stock payout than its actual free cash flow. So here, for example, 4.758. That puts it at a payout ratio of 121%. But we're looking at their earnings per share, and even if they fell down into that lower range, lower estimate here of $6.02. You can see here $6.02 for Walgreens. What was it? Is that correct? The current, so $6.37 per share. Oh, here, earnings per share. This is showing $5.98. So they're still having higher earnings per share into the future than what this is actually giving them, putting them at a lower payout ratio for their actual earnings and payout. And if we look at these three companies, if we just overall look at the last 10 years of their revenue, their net income, their free cash flow, and we go percentage wise, just looking at their percentages, we can see their revenue year after year. While it does have a few dips here and there, overall their performance is positive for all revenue, net income, free cash flow. Kellogg's, we look at the same. Kellogg's has had a bit of a dip here. We can see revenue has been returning. So just recently, as of 2017, I believe, if we look at the last 3 years here, their free cash flow has, or their net income has begun to pop back up. Their revenue has taken a little bit of a difference here in 2018, and their free cash flow, I believe they made some what was it? Kellogg's. They made Blue Buffalo. I believe that was it. They made an acquisition, which is why their free cash flow here has came down pretty hard. And oh no, Blue Buffalo was General Mills, so not Kellogg's. I'd have to look in if they've done any sort of acquisitions here recently. If we look at Walgreens here over the past 10 years, again, looking at the revenue, free cash flow, net income, all positive here. 2015, they had a bit of a turnaround here, popping up a lot further, a lot faster here into the future. So those are the three stocks. I hope my video was not too long. I went over the process of how I look at my specific stocks for the week. You know, normally I may go through here and take just a few minutes to look at, okay, what stocks are down, what stocks gave me a better discount this week, are they going ex-dividend? Great. You know, are they going to be raising their dividend in the upcoming future? That doesn't really matter as much. And then I'll just buy those specific stocks because I've already made the decision to buy into these stocks in the past. There's no reason for me to cut them currently. And that would have been it. Within 5 minutes of just logging on, getting that information, I would have already chosen the specific stock. So here's what we're going to be doing. I'm adding $115.38 into the market. I'm dividing that between three stocks. So I'm going to be buying $40 of each of these stocks. We'll say $39 of each of these stocks. So again, I'm just going to go sort this really easy here. I'm going to go here and sort by the negative. I'm going to be buying Triple M. And I'm going to go ahead and set this for $39. Make sure I actually set that in there correctly, 39. And again, I've kind of gone over this in another video. I like to overshoot because sometimes I do have some dividends that come in, and because those dividends come in, I'm going to go ahead and buy. I'm going to put this one at 45. Some dividends sometimes come in unexpectedly on a Monday, and I'm not going to sit here and go through my portfolio just to see which stocks are going to be paying out Monday. I know a few probably may end up, and then Walgreens here, we'll do this one as well, and at $39. So we're going to have available orders around $123. We're not actually going to be buying $123 of actual stocks. We'll end up buying whatever amount we actually have. I'm going to be adding $115.38. I'm not expecting, where's my little tic-tac-toe spreadsheet? We're in May. We've already had JP Morgan payout. I've had AT&T, and what was the other one? I had one other company pay out. AT&T and General Mills. So AT&T and General Mills already paid out. Oh, week one right there in May. I'm not sure, I got these backwards here. So Apple should be paying out here. AbbVie should also be paying out here. And kind of going forward, should see Lowe's, ABM, Walgreens here in the future. So yeah, we'll just kind of look and monitor that here in the future. And that is basically all I wanted to cover in today's video. Hopefully it wasn't too long. If you guys did enjoy the video, again, hit that thumbs up. If there's any comments, questions at all that you came across in the video, drop them in the comment section below. You kind of saw my whole thought process. It's not for everyone. Buying up all these stocks, investing the way that I invest. I'm going to be going through a video here upcoming on probably Wednesday taking a look at all the dividend aristocrats here that have grown and paid out dividends for the past 25 years and going higher. I'm going to be punching them over into my fundamentals and going through and removing any stocks that have not been growing their revenue, net income, free cash flow, and their dividends here. So we'll do a quick rundown there. So that's it. Thank you all for tuning in. I will see you next time. Have a great day. Bye.